When your options deep in the money, say a 180C, and the price is trading at 225, is it more beneficial to exercise or sell and buy shares manually? That's up to you. You can sell the contract and then wait for the price to drop, which it like. Here's the thing though, if they roll, the price is going to continue upwards into the roll date, and this is kind of probably the most difficult part of this whole thing is if they roll, the price continues up, right? If they don't, the price will go down. And it appears that this area is somewhere around the break point for that to determine if the price will continue to go up or it will go down. And that was true in the previous cycles as well, but it varies by a few days. So I haven't included it in my analysis because it's kind of irrelevant. It'll either just continue up, and you'll be able to tell, right? Because it'll continue up immediately, or it will trend down from around the midway point. So if the stock trades flat and has a hard time running up for the next few days, it's likely they're not rolling. No, it's not YOLO anything. These are just various strategies. Critters. If GME is at 165 on 1123 and I buy 12 through 170s and plan to sell on 1124, do you think that play will make money if we go to 210, 220 on 1124? Of course. First of all, you've got, 30 $40, $40 to $50 intrinsic. So if you have a 170 strike, which is here, so you have a 170 strike, which is right here where that blue line is, and we go up to say we go up to 210. Let's make it easy. We go up here to 210. Right? This is all intrinsic value. So without IV, your contract will be worth 40 times $100. Plus IV percentage, however much your IV has grown. So say we're at 70% IV when you buy them, IV goes to 150%. So let's say 75. IV goes to 150%. Then this value will be multiplied by 75%. 1.75%. Oh no, I don't think it's all algos. I mean a lot of it, right? Most market trading through funds is done via algos. But I don't think like the cycle is locked in by algorithms that are just running wild. I don't think she does either, but that seems to be the implication you're making. I've spoken with her quite a lot. I don't. I think she thinks they're using. I mean, they are right. If they're short, if they're short volatility, then they're using algos to hedge that volatility, either to the up or downside. Do I need to send tuition for watching this? No. When rolling up and out, how far out do you would you roll in terms of percent? I mean, I would sell on the spike, wait, um, for a decline, then buy back in before the next spike, and then at the top of this spike, roll out and secure a safer long-term position. Sell high, buy low, you know, just like stocks, but more. Is it possible that they try to throw off the cycle? Yes, it is. I don't think they can, however. If they could have thrown off these ETF expiration dates for every quarter, they would have, and they haven't. This has occurred 6 times, or this will be the sixth one. 1, 2, 3, 4, 5. So this would be the 6th event, and they didn't throw it off here, and the knowledge of it was public. Like, I mean, I was discussing August 24th for a while. I think other people mentioned it as well. I think maybe Crayons brought it up at some point, as the 35th was one of his T plus 35. It's T plus 35, and that's where that's when he pulled back on the oh crap. I have to put all these back in. It was T plus 35 from quad witching, which was here. Which was when all those puts were. I think. Was it? Hold on. No, it wasn't. I'm not sure where he got it from. Actually. Maybe it was from the monthlies? So that would have been 35 days. So it would have been 35 from the 21st. I'm not sure. I do think he mentioned August 24th. I think it was just the understanding of what drove it was incorrect. Like, everyone assumes it's from those, like, out of the money puts. And I don't think that's right. I think those out of the money puts are part of their volatility model. So they're used to hedge the volatility. Is retail paper handing? No, I don't think so. So I think they've been can kicking a short squeeze for a long time. But I think this window that we're running into in January doesn't allow for that. I don't know how they stop this a second time, especially with the price where it is. You have to remember that we went into this window last year trading at like $20. And we peaked at 483. Even if they turn off the buy button this time, I don't think they can stop it. I think they had a year for the market to crash and possibly get out from the positions, or to get retail to sell. I mean, their initial assumption had to be, if we wait a year, retail will sell, right? How could they have predicted that thousands upon thousands of people would hold one stock, who never participated in the market before, hold one stock for an entire fucking year, And they've run it up. They've run it up to 350 and we held, and they ran it up to 350 again and we held, and they've tried chopping it sideways for months at a time and we've held. Yeah, if you trade on Fidelity, you need to use Active Trader Pro if you're actively trading. You can't fucking trade their Visa like with their web app. It's garbage. Who the fuck's gonna take their bags? I mean, they can lock up that short position in derivatives and swaps, but no prime is gonna take on their risk for them. They can internalize those contracts and hide them from reporting requirements, which is likely what they've done. What I'm trying to say is that January is not the same as all the other cycles. Right? That's the first thing that everyone needs to understand is this cycle is not the same. All the other cycles are very simple. They are ETF, roll or not roll, fail. Right? And the ETF is what kickstarts the increased price action. That was true last September, last December, September, last November, when that's last February, June, and August, right? The difference is this time is that thing, that exact gamma exposure moment that kicks off the cycle doesn't happen just once like it does on all the other cycles. It happens 3 fucking times in a row. And each at more momentously than the time before it. Can you explain rolling options? Is it the same as selling your option and buying a new one at the same strike price? Or is there more to it? Yeah, well, I mean, that's just a straight roll. Is you would sell and buy a new strike further out in order to maintain the same strike. You can increase your leverage by rolling up and out, or you can decrease your risk by rolling out and down. They're fucked. They're super, super, super fucked. So this thing that we've run up on every time right here on November 24th, this happens again here. Except instead of quarterlies, it's leaps. And then it happens again here. And it's then more leaps. And GME leaps. You acted mysterious yesterday when someone mentioned the 50-cent puts that you had said were a nothing burger. Spill it. They are a hedge against volatility. But there'll be more in the DD. We're working on it now. Something's different about you today. You're hyped, and now I'm hyped. Yeah, because we're about to enter 19 days of sideways trading before this shit takes off. And people need to know that here's what I don't know. I don't know if MOASS is a self-fulfilling prophecy or not. Is the knowledge that this is MOASS Or this is the greatest potential for MOASS, what people need to know. And if it is, then I need to let people know that this is likely the highest probability moment, right? The corner we've backed the short hedge funds into, this is the corner. And so, based on the SEC report, if retail did what we did last year without knowledge that that's what was happening, imagine what it could be this year with us having that knowledge. This is the guillotine. Like, that's what this represents. They are exposed from every angle that we know that they have hidden the short position on this stock. Well, if they don't roll, they're not hedged. A user. How much does this depend on retail buying options? Well, I multi-blues. Last January did not happen because retail bought stock. Now, I know the SEC said it wasn't a gamma squeeze, but it was a gamma ramp. And if we'd gotten the price high enough, it would have been a gamma squeeze. And if it had been a gamma squeeze, it would have been a short squeeze. So, because that's the goal for MOASS, right? For MOASS to occur, the price has to go from where it is now up to a level at which it's no longer sustainable for those short on it. And once it can cross that point, then MOASS. It's not MOASS is that's what you need. That's the booster rocket, right? That launches this shit to the moon. GameStop needs to go from 170 to like $1,000. And the only way retail could ever present enough pressure for that to occur is with options. So yeah, you can lose a lot of money on options. They are risky, but they also present leverage. And leveraged retail is the world's biggest fucking hedge fund. And January proved that. I fucking love you, man. Thanks, Index Fund Investor. All right, I'll clip it.